June 5, 2010. The Real Estate Capital Scoreboard. June 2010. Chicago, Illinois, June 7, 2010. More positive news on the realty capital front as recovery from the current downturn is recapitalized by funds which were raised prior to commercial mortgage product being more widely available. Funding demand is readily available for freshly originated capital underwritten to currently more stringent standards. In particular, many non-investment grade credit funds desire new commercial mortgage exposure as secondary market spreads have rallied. How does revived realty capital market translate to property-level funding kinetics? New benchmarks, the debt yield, in place NOI divided by total debt, has now emerged as a popular underwriting index. This index provides a quick gauge of the debt payment cushion, similar to the debt coverage ratio. For example, 9.5% to 10% was common yield and during the market peak, 2007 to 2008, now the index falls within the 11 to 12% for most types of permanent loans. Favorite fives, the number 5 seems to be the most favorite digit for tweaking deals. Funding sources use the number 5 in many different underwriting scenarios including 5% more leverage, 70% versus 65% LTV, 5% less debt coverage, 120% versus 125%, 5 years more in amortization, 25 years versus 20 years, and 5% more occupancy in improving markets, 90% versus 85%. Floors, in select cases, lenders reduce, or even eliminate, floors and rate protection for floating rate loans on shorter-term debt, for example, 5 years or less. Rate protection can be waived for lower leverage loans, generally 50% or less. Simultaneously, rate floors are dropping to 3.5% to 4%, as funding sources favor quality over more realty risk. Thinking outside the box, new market tax credits, private placement offerings, for example, CIS-sanctioned DB5 Foreign Nationals Program, Recovery Act funds and other non-conventional funding vehicles are gaining attention, especially for new construction projects requiring substantial subsidies and equity capital. Such funds can be used for more challenging assets including senior housing, retail and mixed use as well as lodging properties. Available on a select basis and in very focused areas, these programs are highly technical and therefore require substantial consulting expertise for processing. The Real Estate Capital Institute's advisory board member Aaron Gruen suggests many economic indicators are improving, indicating the worst of the Great Recession is behind us. However, while the capital markets are showing improvement and signs of increasing stability and recovery, asset-level performance improvement is spotty and inconsistent. Heightened volatility and uncertainty continues to reign. He adds, targeted risk analysis is especially important today, given that uncertainty and ongoing shifts in demographics, consumer behavior and variability in economic and fiscal performance between and within regions that can be expected.